Introduction to private limited companies. A private limited company is a type of business entity that offers limited liability and a separate legal entity to its shareholders. It is formed with a minimum of 2 members and a maximum of 200 members. This structure is prevalent due to its legal protection, ability to raise capital, and perpetual succession. Overview of financing options for private limited companies. Equity financing. Private limited companies can raise funds through the issuance of shares, venture capital, or private equity. These options allow business to obtain capital without incurring debt, offering shareholders an ownership stake in the company. Debt financing. Another common method for private limited companies to raise finance is through bank loans. Non-banking financial companies and debentures. This strategy involves borrowing funds that must be repaid with interest over a specified period. Government schemes and subsidies. Government support can also be accessed, providing financial assistance and subsidies to private limited companies for specific growth initiatives, innovations, projects, or other qualifying activities. Importance of raising finance for growth and expansion. 1. Facilities expansion. Riser finance enables private limited companies to invest in new product lines, enter new markets, or expand existing operations, leading to business growth and increase in market share. 2. Supports innovation. Access to capital facilitates research and development, innovation, and the adoption of new technologies, giving companies a competitive edge and positioning them for sustained success. 3. Improves financial stability. By securing adequate financing, companies can strengthen their financial standing, meet obligations, and weather economic downturns, fostering long-term sustainability. Legal frameworks governing financing in private limited companies. Company Act compliance. Private limited companies need to adhere to the regulations specified in the Companies Act 2013, ensuring the transparency, accountability, and legal compliance in their financial activities. SEBI regulations. Securities and Exchange Board of India must be followed when dealing with securities, ensuring fair practices in equity market transactions and investor protection. Taxation laws. Understanding and compiling with tax laws and regulations is crucial to managing finances effectively and minimizing tax liabilities while staying within the legal framework. Equity financing. Issuance of shares, venture capital, and private equity angel investors. 1. Issuance of shares. Companies raise capital by issuing stocks to investors, offering them partial ownership and voting rights in decision-making process. 2. Venture capital and private equity. Specialists Specialist investment firms provide funding to companies with high growth potential in exchange for equity, aiming for substantial returns on investment. 3. Angel investors. Individuals or groups with significant financial resources invest in early stage business offerings, expertise, and mentorship alongside capital. Debt financing, bank loans, non-banking financial companies, debentures. Bank loans. Primarily obtained from financial institutions, bank loans involve borrowing specified amounts with repayment terms and interest agreements. Non-banking financial companies. Alternative lending sources provide credit facilities to businesses, often with a more flexible approach compared to traditional banking institutions. Debentures. Debt instruments issued by companies acknowledging a specified amount of borrowed funds and agreements for repayment with interest at a future date. Government schemes and subsidies. 1. Financial assistance programs. Government initiatives provide financial aid and support to private limited companies, stimulating growth in specific sectors or geographical regions. Grants and subsidies. Various schemes offers grants, tax incentives or subsidies to the business engaged in activities aligned with government objectives such as R&D or environmental sustainability. External commercial borrowing and alternative financial options, crowdfunding, peer-to-peer lending, and hybrid instruments. External commercial borrowings. Business can raise capital through loans availed from foreign sources to meet expansion plans or finance specific projects. Crowdfunding. An online platform where a large number of people collectively contribute funds to support business ideas and projects in return for potential rewards or equity. Peer-to-peer lending. Direct lending is facilitating through online platforms, connecting individual lenders with borrowers, offering an alternative to traditional banking challenge. Hybrid instruments. Financial tools combining features of debt and equity, offering companies flexibility in managing their capital structure and investor returns. Tata Capital Financial Services versus Kirusa Software Private Limited 2020. Case background. Tata Capital Financial Services provided financial assistance to Kirusa Software Private Limited, which subsequently defaulted on its payment obligations. Tata Capital initiated proceedings under the Insolvency and Bankruptcy Code 2016 before the NCLT to recover the outstanding amount. Kirusa Software contested the claim, arguing that the transaction was not a financial debt but an operational debt, which would fall outside the purview of the NCLT. There are some key findings like the NCLT analyzed the nature of the transaction between Tata Capital and Kirusa Software, scrutinizing the relevant agreements and documents. It assessed whether the financial assistance provided constituted a financial debt or an operator debt, as a distinction would determine the appropriate legal resource for Tata Capital. Judgment. The NCLT ruled in favor of Kirusa Software, concluding that the transaction in question was an operational debt and not a financial debt. As a result, Tata Capital's petition was dismissed and the company was directed to pursue alternative legal remedies to recover the outstanding amount. This case underscores the importance of accurately classifying debts and understanding the jurisdictional limits of legal forums. Mrs. Innovative Industries Limited versus ICICI Bank Limited 2018. Case background. ICICI Bank Limited initiated insolvency proceedings against Innovative Industries Limited under the Insolvency and Bankruptcy Code. Innovative Industries challenged the NCLT's jurisdiction and the constitutional validity of certain provisions of the code. The case eventually reached the Supreme Court of India. 2 key findings. The Supreme Court examined the Insolvency and Bankruptcy Code and its provisions, focusing on the jurisdiction of the NCLT, the rights of operational and financial creditors, and the constitutionality of the code. The court weighted the objectives of the code, such as time-bound resolution of insolvency, against the rights of the parties involved. Judgment. The Supreme Court upheld the constitutional validity of the Insolvency and Bankruptcy Code and affirmed the NCLT's jurisdiction in insolvency proceeding. The court dismissed Innovative Industries' challenge, emphasizing the need for a robust and efficient insolvency resolution mechanism in India. This judgment played a crucial role in shaping the legal framework for insolvency and bankruptcy in the country.